Hello, everyone, and welcome to our first webinar session of 2026. This one is called Investment Markets Live, What to Watch For in 2026. My name is Tom Bittinger. I'm with the marketing team here at Wealth Enhancement. And before we get started, just want to go over a couple quick housekeeping items. One, there will be a Q&A session at the end of the presentation, so feel free to submit your questions using the questions pane, and we'll get to as many as we can. Anything that we don't get to, we'll keep that, and we'll have an advisor reach out to you individually with a response to your questions. Also, this is being recorded, and a replay will be sent to you as soon as we can get one. Should be in a day or possibly in the next couple of days, but we'll be sure to check your inbox for that. We'll get that out to you. With that, I think we should probably jump into it because we got a lot to cover here. So joining us today is Jim Kahn, Chair of the Investment Committee and Chief Strategy Officer here at Wealth Enhancement. Jim, like I said, we got a lot to cover, so take it away.
Thanks, Tom, and thanks everyone for joining us. Today I'm joined with Doug Huber, who's our Deputy Chief Investment Officer. Very smart guy. We sit on the Asset Allocation Committee together. I enjoy debating with you, Doug, about what's going on in markets and in portfolios. And Gary Quinzel, who's our Vice President of Portfolio Consulting, also a smart guy. Really sort of has a deep expertise across asset classes, and always enjoy what he has to say, whether it's fixed income, alternative asset classes, or equity. So thanks for joining us, guys. So let's just, it feels like we're already deep into 2026, but let's just reflect a little on 2025. It was a remarkable year. Okay, we've had remarkable returns in equity markets for the last 2 years. If you look at the S&P 500, it was up almost 18%. Maybe more surprising for a lot of people listening, if you look at developed markets, so that's Europe and developed Asia, it was up 32.5%. A lot of that was because of the dollar depreciation, but still, if you were holding equities in places like Germany or Australia or Japan, you had a great year. Emerging markets, which have been kind of a perpetual underperformer, were up even more at 34%. If we look at fixed income was pretty much up across the board. A little hiccup in municipal bonds earlier in the year, but on a tax-adjusted basis, that 4.3% is still a pretty good return against the global ag and the U.S. ag. Interestingly, high yield was only up 8.6%. So you look across sort of, relatively riskless and relatively riskless fixed income, you didn't get that much premium on a high yield. We'll talk a little bit about that. All in all, this was a great year for diversification, right? We always preach diversification. It's important not to put all your eggs in one basket, stocks and bonds, but then go even further and have additional asset classes. In this case, having international and having emerging markets, having bonds in the portfolio was generally additive. And so I think this is a great proof point. If you stick with diversification, eventually it does pay off. Next slide, please. So as we look into 2026, there's some three big themes that we're focused on, okay? The first theme is inflation. There's a lot that's driving inflation in our economy, right? We're shrinking our labor force by shrinking immigration. We have tariffs threatening across a variety of sectors and industries, which is pushing up prices. And we have employment, which is pretty close to full employment. And yet, even though there are all these things pushing on inflation, pushing prices up, we're actually seeing a trend of disinflation. The inflation rate is coming down. So we're going to talk a little bit about that push and pull between all these forces that are pushing prices up, and yet we continue to see the rate of price changes come down. Now, a lot of people confuse disinflation, which is prices going up a little more slowly, with deflation, prices coming down. You don't want to see prices coming down because prices tend to only come down when you have a major recession or a depression. So you're not going to see the price of eggs come down dramatically, or the price of cars come down dramatically. What you'll see is that they'll stop going up so fast, right? That's disinflation. We're looking at the labor market, right? Because consumers and spending is the primary driver of GDP in the United States. And so when the labor market is performing well, the economy is performing well. That's generally been a rule of thumb since World War II in the US. There's a lot of doom and gloom out there about the labor market, but if you actually look at unemployment, unemployment's still low on a historic basis, right? And people are still able to find jobs and switch jobs, even though they're feeling a little bit less secure than they were maybe 6 or 12 months ago. Behind a lot of that is the talk about AI, artificial intelligence. Now, AI replace jobs. We haven't really seen it yet. Anecdotally, we've heard some stories, but we haven't seen it. What we're really looking at here is the push and pull between the feeling of things being gloomy and AI potentially being a labor market detriment to the facts on the ground, which is labor market actually seems to be okay. The final thing we're looking at are corporate earnings. Why corporate earnings? Corporate earnings are what drive equity markets. When corporate earnings go up, businesses are worth more, people are willing to pay more for them. Consensus right now is for relatively fast growth in corporate earnings on top of 2025, which was a great year for corporate earnings. Now, a lot of that growth is not in the tech sector. So the question is, will this spread beyond tech? Will we see other industries have the same type of earnings growth that we've seen in technology? Maybe not the same, but just kind of close in a little bit. Because if we do, that's going to be a great driver for equity markets. And how we get there matters, right? Will we see top line growth continue to grow? Well, if we keep seeing GDP, at the upper end of 3 to 4%, yeah, top line growth is going to grow a lot. But if we start to see a cooling in top line growth, will we actually start to see margins continue to expand? They're kind of at all-time highs margins, not much room for them to go. But with AI and the technology, maybe they can push up a little bit further, which is great for stocks and also for corporate credit. So as we look into 26, expect us to talk a lot about inflation, labor markets, and corporate earnings. These are going to be the things that we're watching to sort of help us understand what's going on with markets. And now I'm going to turn it over to, I think, Doug to talk a little bit about what's going on the equity side.
Yeah, thanks, Jim. And I think we're going to echo a lot of what you just touched on there. I think after 2+ really strong years in the equity market, the question really is, what is 2026 going to reward? Is it a valuation market? Is it back to growth? Is it quality? Is it defensiveness? I think as we look at it, a lot of what has been happening thus far has been margin expansion, right? There's a lot of excitement about the potential of what AI and some of these other themes bring, but we actually think that there's a potential that we're entering a market where themes like AI, the path of inflation, labor dynamics, policy uncertainty, these are all connected. And those change relatively quickly, but these are the cross currents we think that are likely to drive the markets in 2026. We can think of them as the inputs to returns. And so likely, we believe at least that it's more going to be a fundamentally driven market based on earnings growth and interest rate expectations and other things more than that multiple expansion. And so the big meta point here from this slide is we do believe dispersion hopefully will stay elevated this year. And if you look backwards, there is some anecdotal evidence that when markets transition from this policy-driven market, big macro kind of trades on to more of a fundamentals driven market, we often see a leadership rotation and broader opportunity sets open. And so on the next couple of slides, and I think Gary as well, we're going to touch on some reasons why we think that dispersion is going to exist and also what we think is going on with kind of the underlying fundamental case for these equities. So, to the theme of AI, let's just jump forward one slide here. I think the big theme, the big thing that's been talked about a lot is AI and all the spending that's been going on. And man, is it an astronomical number. I mean, frankly, I read it sometimes and I think it's a joke. There's too many commas in there. But the fact of the matter is these hyperscalers are throwing a lot of dollars at growing AI. They really believe in the use cases for it. But what we're showing here is that we're actually seeing a decline or projected decline coming down in the next couple of years. And so I do want to make it very clear, hyperscaler spending is still going to be very large in absolute dollars, but that growth rate is moderating. And so this is a classic move of kind of a build out to an optimized phase. And so this isn't the end of the AI build, but more likely a transition from kind of what we could think of as a land grab where it's get as much as you can to more, let's focus on efficiency, let's focus on utilization, let's pay attention to a return on our investment. And so for investors, the key of this elevated CapEx still supports, a broad ecosystem, right? The computing power, the network, the energy to power it all, data centers, cooling. There's going to be a lot of things that benefit from these dollars. But I think the slower pace here is actually could be constructive, right? It may reduce this overhang of overheating that we hear, this risk of are we going too fast? And I think that shift also rewards companies with more durable cash flows and some pricing power. And so if you look at prior tech cycles, let's think of cloud and mobile, the early winners were really obvious. But actually, if you look, the best risk-adjusted returns often came from that second wave, the picks and shovels, the services, and those that were the profitable adopters. And so we'll talk about that a little bit on the next slide here. I think if you go forward one, it's all about efficiency with AI, right? Everybody is pricing this in. This is one of the most important macro questions for the next several years. You can see this trend line here is the historic growth of GDP in the United States going back 150 years. That line is relatively, bounces around that 2% trend. And it looks really tight because this is a logarithmic scale. It obviously goes much higher and lower if we were to zoom in. But the fact of the matter is it marched along that trend pretty continuously for 150 years. The question is AI the thing that meaningfully lifts productivity enough to raise that long-term growth trend above 2%. And Mr. Market is already voting yes. There's no question about that. The debate here is the timing and the distribution of it. And so if you think of who in the market is really pro-AI, what we call the bull case, the ones that really believe this is taking off, the argument is that AI should dramatically reduce labor intensity in things like knowledge work. It's going to improve capital efficiency. It shortens innovation cycles. And so all of those things should support higher margins for businesses, higher output per employee, and even drive new business models. So all of those things seem like a really good backdrop. But, the flip side to that is everybody's priced that in. Valuations are already assuming that. We know things are priced relatively high. And so when that happens, now you're betting on execution risk. Are these businesses going to deliver on these promises that they may or may not have even made? The market might have made it for them. The other thing that could happen is those productivity gains could accrue unevenly. And so that could result in labor displacement in different pockets. Maybe it's a different type of consumer that gets displaced, or different jobs, or different geographies even. And so that could actually have an opposite effect on GDP, potentially dampening it. And so you have this yin and yang, this back and forth of positives and pros and cons of is this efficiency argument real? I think the takeaway here is not, does AI matter? It does. There's no question about that. But who's going to capture the gains? And I think that right there really reinforces this idea of why dispersion, factor exposure, and selectivity are probably going to matter more in 2026, as it's about that fundamental. So with that, I think I'm going to pass it over to Gary to really run through our cases on the fundamentals of the equity market. So Gary?
Thank you, Doug. I'm just building off the framework that both Jim and you laid out. I mean, if you look at the macro backdrop that Jim described, we have this overall situation where things are fairly moderate, right? We see rates stabilizing. We see disinflation. We don't see labor falling off a cliff, right? All of that adds some stability. And I think if there's some good news out there, it's that from a consensus standpoint, there's a lot of positive or bullish outlooks out there. Now, one could take a contrarian view and say it's maybe a little too overly bullish, right? If you poll all the thousands of analysts out there, if you took all the thousands of analyst reports out there on stocks in the S&P 500, they're overwhelmingly positive. That would imply 17% upward price pressure on the S&P 500 today, which we've seen. We've seen 3 years of double-digit S&P 500 growth. The difference right now is that we are seeing a turnaround in the fundamentals. We're seeing positive expectations. And as the chart here describes, last year, the bottom line, that orange line, that shows 2025. Things were really stable going into the beginning of last year. And then we saw a little bit of a drop off with the tariff situation and expectations for a downturn in the economy. That stabilized, and we saw upward from there out. Things have also turned very positive for 2026. So the expectation right now for earnings on the S&P 500 around 310. So that is quite positive. That would imply a third straight double-digit year for earnings per share growth. Now, why are things so positive? Well, Doug laid out the case really, really well. He talked about the efficiencies from AI. We talk about the consumer kind of establishing themselves. We're seeing a little bit of a bottoming out of some of the concerns that might have troubled us a little earlier last year. So from a base case perspective, things look pretty okay, but I want to dive in a little more deeper. And instead of just looking at the underlying estimate, the average estimates from an analyst perspective, let's jump forward a slide, and I'm going to talk a little bit more about both the bull case and the bear case. And so what are the reasons why stocks could do even better from here out? Well, the first one is margins are looking to continue to expand. And so this is just looking at the operating margin forward-looking of the stocks in the S&P 500. And we've seen these peaks in the past, and that kind of coincides with different stock market cycles. And what we've seen recently is really an upward trend. We're actually in historically high territories. And a big reason for that are some of those things that Doug talked about, some of the efficiencies embedded with AI. But we listed some other things that really are quite positive right now. Some of the reasons why we're a little constructive on equities, we're seeing fiscal stimulus. We know that a lot of the impacts from the One Big Beautiful Bill are going to go into effect. We're going to see incentives for capex. We're going to see more potential money in consumers' pockets, for now, for the short term. So a lot of these things do see a fiscal stimulus. And also from an infrastructure standpoint, I'll talk more about that on the muni side in a little bit, but we're overall seeing a more stimulative environment. At the same time, we are seeing expectation for rates come in a little bit, and I know Doug's going to talk about that as well. I also want to talk for a second about breadth, because it's definitely a true statement that earnings per share, overall earnings have been driven by the Mag 7, by the hyperscalers, by those stocks that have been most positively impacted by the AI tailwind. But we are absolutely starting to see that widen now. In fact, if you use just 1 month as an example, granted doesn't indicate what's going to happen for the rest of the month, we are already seeing widening this month already. If you look at small caps, if you look at value stocks relative to growth stocks, we are seeing some of that widening. So all of that happening, not only is it good for those diversified investors, we think it would be good for stocks as a whole, because we have seen a very concentrated stock market for the last several years. If we jump to the next slide, I'll talk a little bit about some of the bear cases for stocks. Now, many of you out there might know that stocks are quite expensive. If we use a variety of valuation methods, usually we often compare price to earnings. We could do the same thing with price to book value or price to cash flow or sales or revenue. They all tell the exact same story, more or less. What this chart does on the right, it's a little confusing, but it's the real main takeaway is that orange diamond there indicates where the price to equity, forward price to equity ratio is for US, international, and a variety of other indices. The story is the same across the globe. Now, the US is more expensive relative to international countries than other countries, but that doesn't tell you anything about where stocks are going to go in the next 12 months. In fact, we often talk about this is a terrible, terrible tool to use for guessing where stocks are going to go in the next year. It does tell us from a longer picture how to think about some of the concerns about entry points and sizing your portfolio appropriately. So that is one thing to be mindful of. The other things we listed there, we could see a more significant downturn in some of that hyperscaler spending. Some of those hyperscalers and chip producers are starting to change some of their finance practices to be a little more debt heavy. Not necessarily a concern right away, but it's certainly a keen observation. And there's some other seasonal things like midterm election years that historically have caused little pockets of volatility. So all things to be mindful of. Doesn't necessarily alter our view, but as we construct our bull and bear view, these are the things that we're thinking of. And so with that, I'm going to pass it back over to Doug to talk a little bit about our fixed income outlook.
Thanks, Gary. I think the tagline here is 2026 in the fixed income market is really thinking about how do we deploy yield intelligently. I think yields are still relatively elevated versus the last decade. I know a lot of us remember the GFC. There was no yield in fixed income. It wasn't filling that piece of the portfolio. And so, given that income component is meaningful again, carry matters. But with that comes some risk, whether that's on the rate side or the credit side. So we're going to get into that. I think right here we're going to talk about the implied rate cuts. We hear a lot and think a lot about what is the Federal Reserve doing. We've been on a rate cutting cycle for the better part of 18 months, and the market is very dependent on, at least price moves are very dependent on what the Fed's going to do. And so the market continues to price in some easing this year, not a dramatic cutting cycle, but more consistent with kind of that soft landing narrative. This graph is essentially saying the market's pricing in roughly 2 cuts this year. This is, though, where we get some volatility. Small changes in an inflation number or a jobs report can really reprice this entire path. There's points in time that this showed 5 cuts, and now it's to 2. If we rewound a year ago, it went from 7 to 2 to 7 again. I mean, it's really quite a volatile gauge in the market as everybody tries to figure out what is the Fed going to do. And so for portfolios, we don't want to treat this rate path as a single forecast, but we want to treat it as a range of outcomes and think about it as a position for risk control. And so historically, gentle cuts have been supported for both bonds and equities. But if they become recession-driven, that's when credit spreads are going to kind of take it on the chin. And so we'll get to that in a little bit. If we move forward here, let's talk about the rate side of things. And this is the yield on U.S. Treasuries. And this is showing the U.S. Treasury curve. What does that mean, right? Let's think about this in real-world terms, right? the front end of the curve. So the farthest left you go here, where you see 2 years. So this is bonds issued anywhere between months to a couple of years. And this is what most people are going to feel in their savings accounts, their money market funds, their CDs, short-term borrowing. When the Fed eventually cuts rates, these are usually where you see that happen, right? That's where the Fed has the most impact. The middle of the curve, that 2 to 5 year range, is really the part that's going to influence your auto loans, your business loans, the intermediate bond funds you might have in your portfolio. And that's where kind of policy expectations and economic outlook meet. And then if you look at the long end, 10 to 30 years, those are really the rates that drive mortgage rates, long-term borrowing costs, and some of your long duration bonds in your portfolios. And so out there, it's really more about confidence around inflation numbers, fiscal deficits, and long-term growth than it is about the next Fed meeting. And so that's kind of the spectrum of the duration side of it. What about the shape of that curve? Why does that matter? So really, when short-term rates are close to or above long-term rates, savers benefit more than borrowers. When the curve steepens, meaning it kind of gets steeper there, borrowing in long-term investment typically becomes more attractive. And so let's frame what we're looking at here. This slide really just shows where the Euro curve is today versus where economists and market participants predict it'll be by year end. And so the key takeaway is it's really quite a small change. Realistically, it's not a big regime shift as we have seen in other markets. So right now, the market's not pricing a drastic steepening or an inversion unwind. It really points to a modest normalization. If you think about the front versus the long, the front end is really, like I said, the piece that's driven by Fed expectations. And so if they do cut rates, you can see here that the expectation is that will fall. The long end really is tied to this concept of inflation credibility, fiscal deficits, which we know is always in the news of are we, how big is our deficit? Are we continuing to add to it? And so people want to get paid for taking long-term risk. It's called term premium. And so that's really what's going to affect that back end. I think, what does that mean for investors? This is not an environment for all or nothing duration bets. We're not saying go all the way short, go all the way long. I think this really is an environment where you can be calibrated for your duration exposure. You want some on to benefit if growth did slow, because that typically can be a counterpunch to slowing growth. But you don't want to take excessive long end risk, because on the back end, it's really volatile and can have really sharp drawdowns if interest rates rise. So with that, that talks about the rate side. And I touched on, if the Fed cuts for reasons that could be recessionary, who's going to feel that? Well, that's the credit side. So let's talk about the credit side. So if we jump forward one page here, this really is showing two different things. This is kind of showing the valuations of credit markets today versus their 25-year history. But it answers a really simple question. Are we being paid for the risk we're taking in fixed income? And I think what it does really eloquently is it separates two things that we often mixed up, and myself and Gary and Jim included: yields and spreads, right? Yields are what you earn on something, spreads are what you're being paid for taking a risk. And so what stands out here? Across most sectors, yields look really attractive historically. So they're sitting in that kind of upper half, almost across all these, in some cases the upper quartile of the last 25 years. But at the same time, spreads are very tight, particularly in higher quality credit. And so this is telling us that returns are driven more by rates in their absolute yields than not by this fear-driven risk premium market. So people are very comfortable with corporate balance sheets, with taking some credit risk above the risk-free US Treasury. And so let's contrast kind of maybe how we interpret this across a couple of these sectors. If you look at investment grade corporates and structured credit, they show a relatively constructive setup. There's decent spreads still in there, especially in some of the structured credit, but their absolute yields look relatively attractive. High yields and bank loans, they have really high all-in yields, but their spread, or what you're paying to take on that risk, is quite tight. And so if you have an environment where risk comes back out, we call it a spread widening, nothing might happen to rates. But if the spreads widen, you could lose some of that money. The good news, though, is because we're starting from a relatively high yield perspective, that can cushion some of that. And so we are not saying run all in. We are not saying this is a massive buying opportunity in fixed income. But I do think the takeaway is that it's less about stretching for risk, but more about harvesting some of this intelligently. So because the spreads are not cheap, it favors quality. We want diversification. We want some active positioning here, right? Really not just saying, let's buy it all. Let's think about where we're placing those bets. And I think that goes across the board here. And you know, if we put it in the simplest of terms, right today, bond investors don't need a crisis to earn attractive yields, right? We're getting paid to lend money again, which is a good thing. Just have to be thoughtful about how we're taking that risk. So maybe with that, Gary, let's touch on some of the other parts of the fixed income markets like muni bonds.
Absolutely, yeah, and I think you did a great job, you know, touching on some of the nuances of the fixed income market and why it's so important, in our opinion, to kind of take that active approach, right, as opposed to just, you know, going after the yields, because there's a lot of moving parts here. And let me use the municipal market as a prime example. And so this is an interesting chart here. What this shows is going back to 2003, the issuance of tax-exempt municipal bonds. So these are bonds that are issued by municipalities. They could be issued by a hospital or a school or anyone trying to raise funds. And you know, it's been relatively stable for the most part for 20-something years. But you know, there's been some blips here and there where issuance went up. And as an investor, that can actually technically be a bad thing, right? Because that increases supply. And if you think about supply and demand, all things equal, supply goes up, demand stays the same. That's actually a negative for muni prices. Now, does that mean that this is a negative situation because we were actually at historically high issuance for tax-exempt munis? Not necessarily is the case. If you understand why issuance is going up, it's actually because of some of the things I referenced earlier, some of the positive fiscal stimulus and overall healthiness of the economy and the issuers that are creating these bonds. And so there's a lot of infrastructure spending, public investment, policy-driven growth initiatives that have been happening recently that are supporting this growth, right? So if you factor that into the broader picture, yes, issuance is going up, but issuance is going up for the right reasons. And we look at the overall fundamentals of the municipal market, we actually see a pretty stable situation. Now, there's always going to be certain municipalities that are going to rate worse from a rating standpoint because of their pension situation or a variety of factors. But when actively managed and sized appropriately, it can certainly lead to outsized opportunities. And so we remain constructive on municipal bonds, especially for those investors that are in high tax states or are looking for tax exempt income. Even though last year we hit a little bit of a rough patch in call it April, right around the tariff situation, really for the last 12 months, ever since then, we've seen positive returns. So there really is a strong fundamental backdrop. And as we look forward, we actually see a steepening on the long end of the municipal curve in the 10 to 20 range, something that you might not necessarily pay attention to, but as active managers, we pay attention to those things, and we're looking for, you know, opportunities to manage the municipal bond ladder where appropriate. And so I think there's some interesting things happening in munis, and I'm going to jump forward one slide, talk about the broader bull and bear case for some other bond markets. And so starting with US Treasuries, if we just look at the bull case, we're seeing, you know, if there is any type of geopolitical concerns, which we've seen recently, not that they necessarily have long-term implications, but that would generally be bullish for bonds, right? And we've seen that time and time again, not every single situation, but that would be bullish. We have noticed, however, that inflation trajectory continues to remain downward. And so that disinflation situation is certainly supportive of owning bonds, because any bond is a fixed income instrument. Inflation is the enemy to fixed income. And so we see that coming down. That is certainly bullish for treasuries. And lastly, hedging properties. And that really ties into that demand for safe assets. It's really the same concept, is that when we do see those flight to qualities, that is those strong hedging properties, especially as correlations from stocks and bonds go down closer to zero or negative. So that would all be bullish for treasuries. On the other side, for corporate bonds.
Gary, before you go on to corporate bonds, so last year when we had the tariff, we call it the tariff tantrum of April, we saw bond yields actually go up, price down, stock market down, and then we saw the Greenland situation kind of earlier this year. We saw bond prices, yields up, bond prices down. So every time there used to be a big geopolitical event, right, investors around the world would want to put their money into treasury bonds because treasury bonds were the safe asset. But now it kind of feels like sometimes we have these geopolitical events and there's money out of treasuries. You want to talk a little bit about that? Because that's a little new, right? Because what you're seeing sometimes is the geopolitical events, you get yield up, dollar down, right? Yield up, bond price down, dollar down. We look a little more like an emerging economy that way, right? That looks like the Argentinian bond prices or the Thai prices to the late 90s. And are we becoming an emerging market?
Yeah, I don't necessarily think so, but there are certainly a lot of moving parts when it comes to foreign players in the treasury market. And so I think that situation has certainly changed, and based on who is selling, right? And if you use Greenland as an example, and some of the same allies that, might have been most impacted by that, they're the largest holders of treasuries at this point. So maybe some of the historical buyers and sellers might have flip-flopped in recent months. So over the long period of time, we've seen this play out where treasuries have been the destination for safe haven, but not always the case. And we've also noticed it also depends on where correlations have been historically. And recently, stocks and bonds have been more correlated. That has not always been the case. In fact, if you go back over time, they have actually been more closer to zero or negative. But those are some interesting anecdotes that you mentioned. Moving on to corporate bonds, I can just really touch on some of the things that Doug talked about, because we talked about how tight spreads are, and that really is, probably one of the things that we're most cognizant of and going to be very closely monitoring, because at any given time you can have a credit event, a random default. We had some very, very slight episodes actually in the public space that last year that sparked a little bit of a concern, but they really didn't materialize to anything notable. And so at this point, we remain supportive for that reason, because we do see default rates remaining low. And overall, as Doug mentioned, the absolute yields are there. They're supportive of, from an absolute perspective, owning fixed income, especially owning corporates. And so we do see limited risk on that, but of course we are always cognizant of changes in the corporate landscape. If we jump forward to the next slide, I'll highlight some of the things on the bear case for each of those. And it's really the exact opposite, right? If we see inflation reaccelerate or stall, that certainly would be negative for treasuries. If we do see a reversal in the rate movement of rates, we saw higher, especially on the long end. Doug talked about where rates are heading. We feel relatively confident that the trajectory on the short end of the curve is going to materialize, but on the long end, it's a little more uncertain, right? That could certainly spike based upon growth expectations, based upon inflation. And at any given time, we do see ebbs and flows about supply overwhelming demand, and that also is impacted by foreign buyers and sellers, and we have seen a shift in some of the foreign interest of the U.S. Treasuries. And again, flipping over to corporate bonds, again, it's the exact opposite, right? So we, at this point, don't forecast recession. We don't see any indication of it, but at any given point, that could change, and we could see, an uptick in refinancing risk. And of course, downgrades could always occur, which could spark material concerns. And so that's the bear case for corporate bonds. With that, I'm going to pass it back over to Doug and talk a little bit about our special topic.
Yeah, I like how we call this magnificent metals. It feels like it's the topic du jour for some time here of to your point, Jim, we are starting to look like an emerging market with the way precious metals have been substituted in for maybe the safe haven asset. And I think that's a great way to segue to this. I think if you think about precious metals, right, they tend to show up when confidence in policy, currencies, or inflation starts to wobble, right? Nobody's really talking about them when equities are doing great or fixed income. They really kind of show up when you have equities and fixed income start to behave a little differently than they have in the past. And so even after a strong year in where gold and silver and some others have touched record highs, drivers behind metals aren't going away. That's not to say we are necessarily bullish or bearish on them, but it's important to point out because it's something we hear a lot about, questions we get a lot about. And I think the biggest driver here is that central banks aren't trading gold tactically, right? They're actually using it to diversify their reserves away from currencies, right? And so that is a big kind of support force to the market in general. And it's a different demand profile than we've seen in past cycles. So that is a structural shift that's going on right now. I think what actually moves gold and some precious metals versus headlines, right? Gold doesn't typically trade on CPI prints, right? Inflation numbers, but it does trade on real yields and trust in policy, right? So if inflation stays sticky or growth slows enough to force some easier policy, that can be a combination that could support gold without a crisis. On the flip side, if we did see that the AI come all the way through, productivity go to the moon, so you get that strong growth plus rising real yields, it's probably an environment where you'd actually see some environment where the metals might struggle, and Gary's going to get into that. So I think, way that we talk about it a lot is really gold's not there as some return driver to beat the S&P. It tends to show up and help when kind of your typical playbooks start working, and that's why we have portfolios available that are complementary to traditional equities and fixed income that might protect against inflation or might serve as a less correlated asset. If everything goes to the moon, more than likely precious metals lag. But when things get weird or currencies trade off, or we have a sell America trade, it can help a lot. And so maybe with that, let's transition to you, Gary, because I know you have a great slide on really kind of this correlation between real yields and precious metals, specifically gold.
Yeah, thanks, Doug. And I think this is really interesting because, one of the common knocks about gold from an investor standpoint is there's no cash, there's no yield, right? So how do you value it? I talked earlier about the valuation methods, and you can do that for pretty much any other asset, right? You can compare its cash flow or its dividends, and you compare it to some sort of price, and so you have some sort of ratio. Well, that doesn't exist with gold, right? It's just something that's been around for thousands of years, and people put some sort of imaginary value on it, and they buy it, and it's driven by behavioral factors. So how are we supposed to know when is it expensive and when is it cheap? And so one way we can think about it is you can compare the opportunity cost of owning gold relative to what we call real yield. Now, real yield is essentially the nominal yield that you would get on a 10-year yield. I'm going to use a 10-year treasury as a proxy, and then you subtract out inflation, right? So you subtract out inflation from the yield you would otherwise get on a 10-year, and then you end up with the 10-year real yield, and the TIPS yield, the Treasury Inflation Protection Security, is a good proxy for that. So if we look at that relationship over time, this is not a perfect relationship. You can go in and find examples where this did not happen, but there's been many, many examples where they move in inverse relationships. And the reason for that is fairly straightforward. It's because the opportunity cost goes up when real yields goes down. And so we see periods where, such as in 2008, 2013, 2015, et cetera, I highlighted them in red. You can see when we see those spikes in real yields, suddenly you have better opportunities elsewhere. And so owning gold becomes less attractive. And so on a relative basis, those were periods where gold looked a little worse. So if you fast forward to the most recent episode, the real yields shot up from negative territory in 2021 up to the highest they've been in about 15 years in 2022. And since then, they've been just kind of settling in. And so Doug touched on all the other really very material factors why gold has been very important to investors for secular reasons, central bank buying, a lot of behavioral factors, concerns throughout the world, geopoliticals, et cetera. But if we simply take a step back and look at some of these long-term relationships, it gives us a little bit of a perspective about how we think about it if you were to try and put a valuation methodology on it, to think of it comparing it to a real yield. And so with that, I think I'm going to pass it back to Jim to take us home.
It's great. Appreciate it, guys. I think there's a lot of insights here, right? Well, the interesting thing is there are always a lot of tensions in the market, right? And so what our job is to unpack those tensions. The market's always pricing in the market's best guess of what's going to happen. And so even a little piece of new information sort of recalibrates those expectations, which is why you have day-to-day volatility. And so it's really understanding those tensions that sort of push and pull that helps you understand the markets. I think as we kind of look forward into 26, the U.S. economy is very healthy. And there are reasons to believe that it's going to stay healthy at least through the first half. We've got stimulus coming in the form of tax rebates. We have AI investment continuing to accelerate. We have margins continuing to expand. We have a employment situation that continues to be relatively healthy. The consumer looks good, and the international economy is okay, right? So it's not like Europe or China are on the brink of collapse, and that's going to drag us down. That said, because of the strength in the U.S. economy, it could take a little bit longer to get to that 2% inflation rate that the Fed wants us to get to. And so we may not see all those interest rate cuts that some analysts have baked in. And so, my bet is we probably get one, maybe two. So I'm a little maybe more bearish in terms of the number of cuts we can get than consensus. But nonetheless, like I still think that a stronger economy is better than interest rate cuts, right? How many people aren't spending because they have to pay 25 basis points more on their credit card, right? I mean, the reality is it has an impact, but it doesn't have that big an impact. We're watching labor markets. We are seeing some weakness in labor markets. So while labor markets are still strong, we're starting to see it's harder to get a job. We're starting to see more layoffs. And people and businesses are saying it's because of AI. Maybe, but not yet. I think what we're seeing because of AI is maybe people aren't hiring as much, right? So it's new job creation that's impacting more than layoffs. But at some point, I play with AI enough. I know Doug and Gary, you play with AI enough. It is going to replace a lot of white collar jobs, right? It's coming, and you have to be prepared for it. There'll be this disruption, and it's going to be scary for certain people. But long run, I think it's going to increase the pie for most of us, and it's going to be net positive. That said, there's going to be some disruption. And then we're watching changes to fiscal policy, right? How much more can the government spend? I mean, we've got a deficit that's 6% of GDP, and that's for one of our planning clients, I'm going to tell you that's pretty unhealthy, right? You got to rein in your spending a little bit, otherwise you're going to end up with problems. We're going to end up with problems if we keep spending this way. If we pull back the fiscal spending, right? If we pull back government spending, that's going to slow the economy down, and so that's going to happen. It's going to happen this year, next year, the year after. It's going to happen. Okay. Lots of opportunities. Stay diversified. I mean, I would tell you that a lot of you, including myself, have struggled with emerging markets international for a number of years, where you've seen the U.S. stocks outperform. It's nice to get a year where those international stocks and those emerging market stocks pay off. I get this question all the time from clients: why would I ever own bonds? Right? Why do I ever own bonds? Well, you're getting a decent yield in bonds today, and it does provide some diversification against bumps in the road with respect to what's going on in the economy. So if we're wrong, and it's possible that we're wrong, and actually we stumble in 2026 and we enter a recession, you'd be really happy that you own those bonds in the portfolio. And so kind of as always, our best advice is to lean into diversification, but lean into it in a smart way, right? You don't need to buy everything, but you have to buy things in an intelligent way. Put the portfolio together, because if you put the portfolio together in a smart way, you get the only free lunch in economics, and that's a little bit more return without a little bit more associated risk. Okay, and so that's ultimately how you win, by investing for the long run through diversification. So with that, Tom, I assume we've got some people calling in with some questions.
Yes, we do. We got a few of them here. First one: will the tech sector continue to outperform?
Gary, Doug talked about equities. Gary, why don't you answer that?
Yeah, I mean, a lot of folks are wondering this. Technology in general has outperformed most other sectors for several years running. There is reason to believe it'll perform very well if you simply look at the bottoms up earnings expectations. Once again, to no surprise, the forecast for technology is ahead of all other sectors in terms of expectations. That said, I think it makes sense to kind of break down what we mean by, is it just technology, or are we talking about the hyperscalers and the NVIDIAs and Max 7s of the world? I think there's a very strong case that we're going to see a broadening of participation within the tech sector. We're going to see more participation in some of the mid and smaller cap tech sector. So you really have to think about it not just from the main names that you're always thinking about. So it goes beyond Apple and NVIDIA and Microsoft, et cetera. But I think there's a strong case to be made. Like I mentioned earlier, we're seeing some broadening in participation across market cap. So maybe taking a more equal weighted approach makes a lot of sense. And certainly based upon a variety of other factors, we're seeing emphasis on some more value oriented sectors. Things like defensive stocks are coming back into play as well. And I don't know, Doug, if there's anything else you want to tack onto that, please feel free.
No, I mean, I think maybe I'll take the other side just to be that guy. I think historically, there's probably two things that really have catapulted kind of tech or innovative companies to the forefront, right? They have been relatively efficient business models. They have good margins. They haven't required copious amounts of debt. They're usually recurring revenue streams. And so that has all been a positive. The other thing is in a market where people are looking for growth, maybe above and beyond that trend line of GDP, those are the areas that have been growing. And so if the market is in a mood to, willing to risk on a future belief, those sectors outperform. If we get into an environment where some of these technology companies start to overspend on AI, they have to issue too much debt to fund that CapEx. Mr. Market's going to start to tell them, whoa, let's pump the brakes. You have a great business model, let's not bust it. Flip side is also if we get into an environment where the market participants aren't as willing to pay for future prospects, they get into more of a mood of show me first, those sectors tend to get moved around a little bit. And so I generally think it's a super healthy sector. We know that there's so much going on there. And I agree that we do believe there's dispersion, not only intra-sector with tech and communication services, but that's going to spread outward too. But yes, I think they're healthy, but there's things to be on the lookout for.
Okay, I'm going to answer this question. I want to answer this question. I want to weigh on those. I'm going to answer it in a way that's a little cheeky, okay? Which is tech was always going to outperform because it's the area where you have innovation. Okay, so 200 years ago they would have called the steam engine tech, right? And today, you don't call the transportation companies technology. And so yes, investing in what's innovative, investing in what's generating productivity, investing in what's generating sort of the next set of sort of big capex spending, you're always going to make money there. The question is, what is it? Right? What is the next thing that's going to do it? And these tech cycles always go in boom and bust. So there's money to be made, but there's also money to be lost. And so yes, tech in general will outperform over the long run, just because what's in tech is going to change. It's going to reflect whatever sort of is new and interesting and unique. But like, remember, like you go back and you look at read about the 1920s. People are talking about airline stocks, right? And these airlines are like it was the AI of the day. All right. Well, on that, I think we have to call it quits with one question today. We went a little over. There was a lot to discuss. Really appreciate Doug and Gary, everyone's insights, and I appreciate everyone listening. And we'll be back to you next time. And until then, if you have questions, go ahead and send them in to us or ask your advisor. Appreciate everyone's time.